Welcome back to the Opportunistic Trader. It's about 1 o'clock on a sleepy Tuesday, pre-fed on a 2-day meeting, and I'm happy to be here with Tommy McEntee, who I've known for probably over 30 years for sure, and he's my option guru, both for the site and in general. I understand his knowledge, and I'm happy that he's able to express it on our site and teach and show people, what he's looking at and how he's doing it. So I want to welcome Tom McEntee.
Hey, thanks for having me, Larry. Actually, it's 32 years, 2 to the 5th.
Yeah.
Long time. It's a long time, brother.
It is.
We were hanging out in the Fawcett office together.
Exactly. We were young.
We were young, yeah. Not anymore. Not anymore.
It's funny. That's like we were, for me, I was younger at that point than my oldest son, which is scary to think about. So
I'm just trying to think. So I was 27. Then what were you, like 24 in '86? How old are you now? 56?
I'm 56. Yeah.
Yes, you were 24.
Yeah.
Yeah, I mean, to most of the people on the site probably don't remember the days of the open outcry, or don't know what it was like.
That was the
so much fun.
That was the greatest experience ever. No one can understand how much fun that was.
Right.
And I talk about it. It's funny. I talk about it sometimes in interviews that I do. I said the most unique thing about the place was. There were a couple of unique things. One, you had some of the smartest people that you'll ever meet in your life next to people that literally were uneducated, and they coexisted somehow. And then it was like a weird thing. It was like a competitive thing because you were trading basically for a firm or your own money, and I was trading for a firm and my own money, and we were really competitors. But in reality, it was almost like we were friends, but during the day we were competing, and
it's the old axiom. It's nothing personal. It's just business.
Exactly. So we had a lot of that, but it's a place.
But you're absolutely right. I mean, the juxtaposition or the contrast between some guys who, that guy Boots, Shield. These are just names that mean nothing to the two of us, and obviously the CRT guys, and then you had some other guys which I thought were kind of like. More like Damon Runyon-esque characters. And that was pretty cool. But everyone could scratch out, everyone could scratch out a living, provided they were disciplined and were risk aware and stuff like that, because of the embedded edge.
Yes.
In the open outcry game when we were there. So Larry and I are not going to sugarcoat it. It took me a long time to realize it, until I went to the screens 10 years ago.
Right.
About how smart. Location made me a much better trader than I thought I was. Than I actually was.
But you still, you know what though? So many guys came and went. So I'm gonna give you a little props because you made it through. A lot of people, people came and went through that place. I always say, on like a side note, like when I left the floor and I went to trade prop at Spear, and the interesting thing was, if you didn't make money at Spear, the rope was so tight that you were gone. So, like, if you saw somebody with a 5-year career at Spear Leads off the floor, you knew they were a good trader because they weren't putting up with that. But, I agree with you. There was definitely embedded edge. It was awesome. But you still, listen, the brokers. When that yellow jacket from Merrill came in with Susquehanna's first program trade that we didn't even understand what that was, you had to watch out.
That's right. Sure. God, you remember those times? Man, right, those two, they come, Spencer and Baldessari would come in, right? They're double team with all these deep calls.
Oh, my God, it was crazy. But that's for another day.
Remember, just to revisit the point you made before about the contrast in personalities, I remember a guy, I'm not going to mention any names, I think the Friday before the crash, so that was Ox 16, and that was the first time. Were you a specialist then, or were you in the crowd?
I was at Fawcett.
You were at Fawcett in the crowd. You were in the crowd with me.
Yeah.
Okay, so that was the first time. I remember they took me out. I was working for a specialist book for Charlton and those guys, and they took me out and had me run, I guess, Pillsbury and something else in the middle of the afternoon. But anyway, it was trading XMI in the morning, and I remember a guy coming in, just a guy like us, a local, buying some November calls. I think the October was expiration. October 16th was the October expiration. So the next month was obviously November. And the guy bought some, November options. Say, I don't know if they were, maybe they might have been a 40 Delta option. And he paid $5, $3, something like that. Okay. Flash forward. Now, I think that day we closed down 20 handles. We never saw the XMI move, it was like $100 down move, I think 108 or something like that in the Dow. And then, of course, you have Monday where the Dow goes down, 500 points. And then Tuesday, they stopped trading.
Yeah, that was the most.
So they reopened. And I run back in there because I had some stuff to unwind or whatever the heck it was. Now it's Tuesday afternoon. I haven't been there since Friday morning. And I remember that same local coming in, offering the same calls that he bought at, say, $3 on Friday, watched the Dow Jones Industrial Average go down roughly 700 points. It was a $2,000 Dow then, so that's 35% by my math. And then sold those calls at $6.50.
Oh, yeah.
I remember he kept looking at the sell ticket and looking up at the screen, looking at the sell ticket. He's digging around in his pocket. He finds his buy ticket from Friday, and he looks at it. He looks at the sell ticket, checks the screen again. He goes, looks at me. He goes, right again.
Well, it's funny that you bring up that trade. I remember I was trading for Fawcett, and I was short. This is actually unbelievable. I think I was short 12 out of the money puts and like 40 out of the money calls. Okay. And the puts were trading at like $60, and I was probably short them at 20 and whatever. But it's, listen, back then we didn't have, the accounts were whatever they were. You had what you had. So I called up Fawcett on the phone, and I'm sure he had a lot bigger problems than my 12 lot. And I said to him, I go, I'm short 12 of these things. What do you think I should do? He goes, God rest his soul, because he's not alive anymore. But he said to me, he goes, son, he's like, stay on the bid. I'm like, I never stay on the bid.
I'm having a heart attack over here.
Well, needless to say, I think I covered them at like 90. They went to like 300. But the worst part of that trade was I was short like a 40 lot of calls that I sold good. I sold them, for good, what I thought was good money to protect against the puts, which obviously it didn't. And the calls I sold at like 14 were $50 bid. And I said to Fawcett, I said, listen, I'm not covering these. I said, there's just this doesn't make any sense whatsoever. And then obviously, within 2 days, that stuff, the whole board went to zero. But the whole point of that story was, that was like the first time that ever happened in anybody's lifetime. So no one knew pricing. It was just people needed to cover the risk. Interestingly enough, just bringing it to the point of on February, I don't know the exact date when this volatility product blew out. Whoa.
The 2.5, right? Was the Monday the day we were down 100?
Right. So 2.5. Okay, that night. Okay, and Mike was trading alongside of me that night, and the put options were literally, obviously they were not like the way it was during the crash, but they were blow up prices. And he could tell you, they were paying any price for any put. So we did see a little of that for a second during that day. So, but other than that, I remember that day like it was yesterday. I remember I was short calls, and I remember what they did to him. So,
well, that's what you say. You never. 2 words in this business I try to avoid: never and always.
Right. And that was a never day, but it happened. So anyway, I'll let you talk options rather than our old stories, because we could probably go on for hours and hours and hours.
It may require a Miller Lite or two.
Exactly, for sure.
Yeah, Larry, I put a trade in the chat this morning. Facebook. I wound up buying the. I'm sure going to share my screen, right? Okay, so I'm going to click on Facebook here. I got a 6-month full chart coming up. Incoming. Here we go. It's almost done. I'm looking here. You can see my pointer, I'm assuming, right?
I see it. Yeah.
Okay. I think charts better than I do. I'm I am more of a dilettante when it comes to technical analysis. I kind of think you can make at least a case on a short-term basis, 160. What is this? 160. I think it was 159-ish, and then this 161-ish level. I think it's a short-term head and shoulder bottom. I think. I also think we spent the better part of 2 or 3 weeks down here bouncing off 160. I got a big mantra: 3 drives to a top. I think maybe you had 3 drives to a bottom here. Nobody likes the stock. I can't find one person who likes it for whatever reason. I don't care. No one likes it. Forget about the fundamentals of it. I want to divorce myself from the news surrounding it and stuff like that. So much bad stuff so many bad headlines have been thrown at it. I'm surprised it didn't take out that 149 low from the Zuckerberg testimony in March. Okay, I want to play it for the long side. I think I'm going to leverage this. I got 2 numbers in mind. I'm going to leverage this 159-ish low to the post-earnings 188 high. That midpoint's roughly 173.5. I'm looking in here. That would also represent, you see where I'm printing here, where I'm pointing here. That would also represent essentially bottom of gap from 9,418, from 173.5 to 175. I'm looking for a move up to there. I mean, typically during these oversold moves, and I guess today to some extent you could say, the rally or the recovery should be somewhat violent. I'm hoping, and I'm looking at 2 other things. And I also think if you look at that, the 200 days up at 180.5, roughly 180.47. I think the stock can get back to the 173.5, maybe 175, maybe inside of 2 or 3 weeks. I mean, that's not really that much. I mean, if it gets up 8 points, that's about 4.5%. That's Apple does that 2 or 3 times a week. So I'll keep that in mind. The call spread I'm looking to buy. Well, actually, I bought it. I paid 83 cents for it. The OC 70.75 call spread, regular way October 70.75. Even right here. Before I wrote these notes down, so I didn't seem unprepared. When I came on the air, the spread was trading at $1.10. The OC 70.75. If we get a 3% move in the stock from here, that's about $4.50. I'm sorry, $4. That's about $5. Puts the stock at 170. That spread is going to be about a 75% return. I think the spread will be worth about $1.80, about $1.85. If the stock trades 170, up 3% from here by October 5. Mm-hmm. So you got what, a week and a half? I guess you got the rest of this week and all of next week. So you got say 8 full trading days. Decent risk reward.
You put it on for 83.
I paid 83 somewhere around 10:15, 10:30 this morning.
Nice.
So that's what I think this thing could trade $1.80. I think look, I'm throwing out the first 2 weeks. I'm going to say nothing's going to happen till October 5. Because I want to obviously, you know how we look. We look worst case scenario first. So I say, but if I get one, I was looking when I came on the air. I was looking at 169.5. That's where the stock was, and it's a 60% return from $1.10. Okay. So I think that's a real good spread. The other spread I did not get, but I was bidding for it and continue to bid, but I may revisit it with different, go back there and jiggle the strikes a little bit. I was trying to buy the OC 65, NOV 75 call spread. And at the time, it was trading at about a 30-cent credit to me. I was offering it at 40 cents. Never got it, obviously. It's trading somewhere around even now. That spread, I mean, you don't want to chase it, obviously. I mean, maybe it's the right thing to do. I don't like to chase. I like to let you hit me out, let you take me. That's just my style. Doesn't make it right or wrong. But I think if even right now at even, if you were to do it, I mean, it's probably a little bit more. I went on the years, but kept $1 lower in the stock. I think that spread is $1 debit to you at 169.5. So that'd be, if you did it for even, you'd make $1 on the thing with the stock at 169.5. You're just trying to leverage technicals, which I think the stock is overdone, and you're leveraging the earnings vol. The earnings month. The earnings is November 2, but the markets are much wider there because it's not a regular way expiration. So I'm using the regular way expiration by proxy, November 16, to take advantage of the embedded volatility therein for the earnings. So I'm leveraging that. I'm taking in 2 or 3 clicks there. I like that play, and it's a flat skew trade. Buying an at the money option and selling an out of the money option. That's a good trade. But here's another one where I'm going out to October 5. 169.5. The spread's worth $1 your way. You make a buck on it right in here. That's a good trade. And I'm looking now. That's Facebook. Okay. Now,
before,
the Apple
before,
QQQ. I'm sorry. Any questions, Larry?
Yeah. No. I just wanted to point out the stock is basically $4 off the low and turned positive as we were speaking here at 165. And I would point out, just for me, just looking at the way the stock trades, I haven't done a trade in it in a bit of time, but it keeps getting, like you said, down to that 160 area, can't break it, keeps holding, and trading up probably somewhere around between $5 and $15-ish dollars. Maybe the next time up, it takes out, like you said, that 175 area, and goes. I mean, as far as the stock and the way it looks possible. Obviously, that is a heavy news stock, and it's taking a lot of negative news, and at this point in stride. I think it was down because the guy that started Instagram left the firm. I don't think he was heavily involved in the firm at all anyway, so I don't know why it was down 4. But I like those spreads, and I think it's important for people to understand, and I really love doing it. If you're buying that spread at 83 cents or even $1 or $1.10,
even $1. Yeah, even $1.
You know your risk. It's giving you full upside play for the most part. Okay, unless the stock just explodes off the planet, then you can maneuver around and do something to continue to capture the upside. But it gives you, a great return, and you can capture the upside. And if you happen to be wrong and the stock gets hammered because of news or whatever, you're pretty limited to your loss of $1, and you can get out for 20 or 30 cents. So you're really not putting on a lot of risk to get into a position where you could capture a lot of upside. So I like that spread.
Thanks. Well, hopefully it'll work. No, I just think it's I'm typically, I don't know about you, but when I buy upside call spreads, it would usually be against shorting stock. But I think this is a great way to lever it to, I think, an oversold stock, and I can buy a lot more call spreads than I can buy shares in Facebook than if I was right. And and I think we should both go into the fact, we don't need the stock to trade at 170. We don't need that. Now, what are we going to do if the stock trades 168 tomorrow? I'd probably roll it up to the 175, 180, right? We pocket it, sell the 165s, buy the 70, sell the, sell the 65.
You can take the whole cost, right? You can take the cost out of the position, own it for free.
Right, that's cool. That's how you manage a position. What we want to do here, ideally, in a perfect world, and obviously it doesn't exist, but if we're lucky enough or fortunate enough to get the stock to move our way in something like this, and we're betting 83 cents. The return there is, we can get 5 to 1 on that thing, right? If we go out at 170 or better at expiration, we're not going to hold it that long. We're lucky enough to get the stock to move up to 168, 169 the next couple of days. I know how I do it. I think you do the same thing. I'd sell the 65s out, buy the 70s, and sell the 75. Just roll it up. Now I own that thing for a credit, and just keep doing that. So I just want to make the options work for me, make time work for me, and just leverage. And you can see you've got a pretty good. I can see the site, and I can kind of infer what the sentiment is about this stock, and it just seems incredibly negative. Not just from people on the site, but everything I see on television. None of the perma bulls on CNBC are even going near it. So they don't ring bells for your bottoms and tops, but every now and then they give you that.
Right, and it's a good way to play it. And it looks like it's moving up almost to the 166 level. So hopefully tomorrow or the next day,
maybe you get a KRD today. You never know. Did it open on the low or just relatively close? Right.
Yeah.
So maybe you get a KRD, but it's a long way to go. Now Lau, we spoke about this trade, and I think it could, it's not as attractive as it was 2 or 3 weeks ago, but I think it still works. And I don't want, like I said to you at the beginning of the, when we got on the phone, I'm going to share a different screen with you. Okay. Did that screen come up? You got it now? Okay. We spoke about this before. This is the Apple QQQ, which I've been doing for a while. Okay, I just been rolling it. I've been trying to stay very, very rules based in terms of insofar as the trade I found was a disparity in not only performance of the underlying asset of the stocks of the respective stocks, but also in the pricing of the options in both stocks. Okay, so as you can see here, this is from last August. How do I want to start this? Let's go back August 1/17 to what is today's date? 9/24. Go back to yesterday. Okay, so essentially down here is a correlation between Apple and QQQ. Okay, now this is from roughly earnings of 2017, which you see up here, 8/1/17 to yesterday, 9/24/17. And I'm running a 20-day correlation on a 20-day moving average basis. Okay, so you see it here. It's a 72 correlator, right? We all know what that means, right? 72 cents in Qs, 72 cents in Apple, 70 cents in Qs, $1 in Apple, and vice versa. Okay, the annualized return on the two in this last, what is that, for roughly 14 months? Apple's been up about 43%. Qs have been up 25%. Okay, now the correlation right now is about, what is it, about 0.55? A little bit less. It's 0.55 now with today's move. So here's what I'm looking at. I think here, it's a 73, and I went back 7 years. I spoke to Mike about this last week. It's about a 67 correlator over the last 7 years, but I think year on year, if you take 1 year, each year on each, the median was about 72 QQQ to Apple. Now, Apple's obviously outperformed 47-25, as we just said, in the last 14 months. Now, this is where it really gets striking. Now, if I go to August 1st, 18, which is the first day after reports, it reported on July 31. Okay. Reported July 31. Earnings came out. Stock closed 190 that day, opened on Aug 1 at 197, and we're off to the races. Okay. Since that period, it's been down about a 0.55 correlation. It had been as low as a 0.22 roughly 2 or 3 weeks ago. But what I really want to focus on is look at the return. Since Apple earnings came out on July 31, I'm not even throwing in where it closed on July 31. I'm just saying where it started on August 1st. August 1st low. The stock's up 16 and change against the QQQ's 4, roughly 3.5 to 1,
right.
3.5x.
So a lot of that spread widenings happened in this quarter off the earnings.
Exactly right. Right. 47-25 over 14 months, but 12 of that 22-point disparity came in the last, what is this, a month and a half? I'm sorry, 2 months, we'll call it. Okay. Now that's one thing I got. So if you believe in some type, and plus the correlation is, it's only about 70% of what it normally would be. Usually about a 0.72, we said, is currently 0.55. Got as low as 0.22, what was it, about 2 or 3 weeks ago, right? Here it is. September 4th. That's when we first started doing this spread. Correlation got way out of whack. And I think you would know better than I. Is Apple roughly 17% of QQQ ballpark? Something like that?
I'm not 100% on that, but it seems pretty much right. I don't know. I don't know if you've looked into this rebalance for the quarter end, but there's a lot of funky stuff coming. So I don't know if that's going to, change.
Now, also in that, I went back and looked. Apple, I went back over 5 years. Apple 20. So we were doing essentially like a variance, kind of a hybrid, whacked out variance swap. 25 delta 30-day calls in Apple typically traded about a 16 volatility. Look at this market chameleon here, which I paid top dollar for, but it's on tape delay. Got like a lot of things in my life.
Go figure.
My brain's on tape delay. It's becoming. It's typically about a 16.1 proposition. So the 25 delta call 30-day out in Apple usually trades about 16 volatility. 25 delta 30-day call in QQQ typically trades about 11.5. That spread would typically be about 4.5 clicks. Buy Q, sell Apple, take in 4.5 clicks. 25 delta call to 25 delta call, and you want to balance it Vega-wise, and you want to balance it dollar-wise, stock dollar, notional-wise, to get you want to have a balanced portfolio. So what I'm thinking here is, I did this already today. I sold the OC 230s
Okay.
They're about a 26 delta. I think I sold them right around, a little bit lower than here, 172. And I bought, this is all October 19 expiration. I'm just trying to stay 30 days all the time, and then hopefully, if I'm lucky enough, to roll out. And I bought the OC 88 and a half. Now, what I've been doing, the way I balance it is the historical statistic, the historical implied volatility for a 25 delta call option in Apple. It's been about 16 at $220 stock, 25 deltas divided by the sum of that same exercise in QQQ, and I get a 9/5 ratio. I buy 9 Qs. I think I bought 9 Qs at 70 something, 72, 73 cents. I sell 5 apples at $1.72. I think I took it at $1.85. We'll keep it simple. I took it at $1.85. Now, the beauty of this spread is this: if I get any type of mean reversion in price in the underlying asset, I win. If I get any type of mean reversion in terms of the value, the relationship between the implied volatility metrics between the two of them, I win. I got 2 things going for me right there. So you're gonna have to beat me twice to get that. I think I just need 1, and I'll come out ahead of the game. Now, let's also look at it this way, because since I have more, I'm not paying. I'm still buying I have optionality in QQQ. Now, if the things correlate on if they correlate on an historical basis, and Apple rallies 5% from here. Let me just see. Where is that? This is on tape. Where is Apple right now?
Apple right now is 122.29, up $1.50 on the day.
So say it rallies 5% from here by October 19th, right? That's roughly $11, right? Mm-hmm. That puts the stock at, we'll say, 233 and a half. Okay, my 230 calls are worth $3.50. We're just going to collapse everything to its intrinsic value, its expiration. This is where we sit. So we rally 5% between now and October 19. The 230 calls are worth $3.50. Okay,
right.
I'm sure. Okay, so now I go to my QQQs. What do I have here? 188, the 188 and a half. If the Qs rally 3%, where are the Qs? About 184 right now?
Qs are, let me grab a quote. You have a quote on the Q? Hang on. Gotta put it up.
184. I don't want to switch off the screen.
183.95.
Okay, so if I get 4% on the Qs, 4% on the Qs is like an 80% correlation to app. It's only correlated 80%, and it's still dramatically outperformed. If I get 4% on the Qs, puts me up $7 and we'll say $7.50. Puts the stock at $190.150. I get 3% on the Qs at $184. I get $5.50. Puts me at $189.50. Right? $189.50. I got 17. Okay, if I get so I need 4% on the Qs. 4% of the Qs is 720, 750 is 190, 150. Okay, my 188 and a half calls would be worth $3. Follow that? Mm-hmm. The 188 and a half are about 75 cents right now. They'd be worth $3 with the stock at 190, 1.5 on a 4% move in QQQ. Okay, 5% move in Apple puts us at 233 and a half. Puts the 230 calls at 3.5. I'm short 5 of those is 1750. 5 times 350. Got it? 1750. I got 9 of the QQQs at $3 each. They're worth 27. That spread's worth $9.50 my way. I sold it for a credit. If I get 3.5% on the Qs, I still win. I just need, if they both go, I just need the Qs to somewhat keep pace on an historical correlative basis to far outstrip any losses I'm going to have in Apple. Because you're long 1.8x to 1 option wise with the Qs. So forget about outperformance. I'm just saying keep up on an historical correlative basis, and I'm going to win and win big. That's why this is working. And I just think, plus
well, also I think what you have working in your favor is you have a massive outperformance in Apple versus the index itself. And if you get any type of mean reversion, pre-earnings, the next earnings, you're going to make on top of that as well.
Right, absolutely. And you saw it yourself. I mean, I think we illustrated that, and you pointed it out.
Yeah, I really like that trade.
Over half the outperformance for the previous 14 months occurred in the last 2 months.
Right. after earnings.
After earnings. So I think this could be a really good play. I think I'm just laid out three things for you. It's not you're looking for catch up in correlation. You're looking for some type of mean reversion in price and some type of mean reversion in volatility. So you got three things going for you.
No,
so
I'd
probably stay with I think there's a lot of things working for me. I don't really need that much. Even if you get 3.5% in Apple, you're talking about 3.5% of the Qs is roughly about what 560 and 650 puts the stock at roughly 190.50. I got 18 against 17.50. I'm plus 50 cents that way. So even if it correlates at a 70, Apple outperforming 3.5% appreciation in QQQ, 5% appreciation in Apple, I still win.
Yeah, for sure.
It goes from $1.85 credit my way to another 50-cent credit my way. So I think I got a lot of things going for me here. So just trying to manage that. I'm not trying to overthink it. I think it's there for whatever reason. You could probably speak to this as well. I've never seen Apple out of the money calls, X earnings take on this kind of. Well, certainly not now, but certainly 3 weeks ago, this type of lottery ticket feel where people are scrambling to buy the upside. Because, why don't you speak about that? What do they like the move to me? Mike and I spoke about this. Why don't you throw your thing in there? The move from Apple post earnings to that I got the 229 something, 229 and a half, I think, in 3 weeks. That was extraordinary. What are your thoughts about that?
Well, I think that's why you're seeing, an upside skew, I guess, because they believe, whoever they are, that the stock can go significantly higher, faster than it can go lower at this point. And plus, it's become a really good day trading stock. We've traded it a lot during the month, and it's moving like the range today is over $3. So, you're having 1% to 2% a day. So I think that's why. And I think these guys got smashed short calls on the way up because they didn't expect Apple to move $40 or $50. So I think a lot of that is in the fact that these things are pricing higher than normal.
Yeah. Mike and I were speaking about that. If you look here, you can see my chart. Am I not sharing it with you? Or can you see it or no? Can you see this?
The last thing I see right now is Qs, but I think it should come up in a.
Is there a chart there? Let me make sure I'm sharing.
Yes. Yeah, I see it.
You see a chart, right, of historical? Yeah. Okay, here. Yeah. Here, obviously, is the inflection. Here's vol popping up because this is July 31st. Earnings are coming out. Now, here, as we see here, this is volatility. This is implied volatility you're looking at. Okay, so now here it is on August 8th. What am I looking? I'm sorry. I put up the QQQs. Hold on one second.
No, don't worry about it. All good.
I was able to. The fact that I was able to log on my phone.
You got us this far. Take us the whole way.
Baby steps. Baby steps. Yeah. Mike and I spoke about this. Here we are. This is earnings. This is the earnings date, July 31. Okay, it's 20. Obviously, it peaks there, right? We don't know it now. Binary event. Boom. Here we are, August 6th. Back down to 15.6. Well, it's kind of been a spot where volatility has bounced before. But now look at the outperformance in the stock. Here's the stock on July 30, July 31. It closes 190, spot 29, and now it's off to the freaking races. But now you look at this. What is this? This is Aug 30. It's trading 225, 227. Now look at the move in volatility. Aug 27, 30-day implied was 16.
Wow.
Aug 30. 30-day, I'm sorry, Aug 31, 30-day implied is roughly 23. So, to me, and we should speak about that. This is important. I don't know if I understand it, but I think you had people, and you should go into this, Larry. People ratio riding the stock, having the stock far outstrip anyone's wildest expectations on the upside, and then fueling this fire. So why don't you talk about that for a second? That might be illustrative to a lot of people.
Well, it's funny. I've made a ton of money doing vanilla ratio spreads. So, like, if I was looking at Apple at that point in time, and even if I would run it with like a bullish skew, and you're saying the stock's at 192, the stock wasn't moving at that point more than a couple of bucks. It was, maybe it had a $10 range over a few months. So a ratio writer would look, they would probably skew out of the money, and I would maybe look at the, because remember, during an expiration cycle, which I look at as potentially 3 weeks, we probably wouldn't run 5 full dollar strikes. So if I was bullish, I would go up $4 or $5. Maybe I'd do the 197, 202, for a small credit or pay very small. And a guy like me, I'm quick to the trigger for whatever reason. That's just how I always am. I would have probably hedged all the way up by selling, puts or buying in stock or whatever. But what happens to a ratio writer or people that are net short on balance, if you can't, I'm selling a $3 put or a $2 put, stock's moving $6, it's not helping me. So I think that's what happened in here. And now there are no net sellers because everybody got annihilated and they've been taken outside the box and have gotten crushed in it. So I think inherently vol is up for that reason. Obviously, it's also up because the stock's moving a lot. It's at record highs or near record highs. And, when you get to $200, on a stock that's moving like this, people are not net sellers. So that's a lot of the explanation for that. And as well, as the stock used to trade what I would call contained. So the stock was contained, and we were able to, buy and sell the stock for a dollar range on the day. Now we have a $4 range. So you have to change your perception, and it changes the skew. What's interesting, and I it's funny, I think of you a little when this stuff happens, but I had been talking for like a week. This is a little off the Apple subject, but I've been talking like a week about this option expiration, that the cash out for the quarterly, and it's amazing what has happened since the cash out. I mean, the S&P is bidless. I mean, it's just been, the S&P's been bidless. Sometimes it'll look the Nasdaq's down 30 and the S&P is here, and sometimes it'll look and the Nasdaq's up 20 and the S&P. I mean, the Nasdaq. Yesterday was the craziest action I think I've ever seen since I've been trading. I mean, it was like the Nasdaq opened down 70, the SPY was down 5, and the Dow was down 20. Then the Nasdaq rallied $120, and the Dow sold off 150 points, and the S&P sold off 5. So if you can explain that to me, right. I mean, these divergences are all computers. They're all, it's like a mania. It's unbelievable. I mean,
the reversal in NASDAQ was nothing short of violent. I don't know if I don't remember seeing that, especially in light of especially with the divergence that
I see the divergence even today. The NASDAQ was down 30 early, okay, and the SPY was down 4, and then the NASDAQ rallied to up 20, and the SPY went down 3, and it's interesting because I think a lot of this might be this reweighting coming. I'm not really sure, but the divergences are making it impossible to trade, or you can trade, but impossible to see what the computers are looking at. And I think a lot, and it relates back a little bit to Apple and what you're saying about the volatility and the option skew. People got blown out of Apple.
Right.
I think
on the upside.
Yeah, I think so. Right. So I think that's now nobody's left around to sell it. So maybe it creates opportunity. I don't know. But
Lau, while we're here, I think one more thing you should mention, because it kind of dovetails what we talked about at the beginning of the conversation, talking about the crash of 31 years ago. Maybe half of the subscription list wasn't alive then, but I don't know. And so there's two stark contrasts there. One obviously downside, one upside. Now, I think what might be beneficial to people, at least my opinion, you do what you want to do. Explain. Maybe you should explain or go into a little bit of detail about buy what you can buy, or in October of '87, it's sell what you can sell, and in Apple 3 weeks ago, it's buy what you can buy. I think that's a good talking point for us.
Yeah, I mean, you could basically, if you want to start off, you can explain a little bit about what that means. I think we're talking on it a little bit, by, understanding, and you know this because you do it for a living every day. It's funny when you see skew on call options, and pricing higher in calls than puts, and
Right.
there was a particular stock. It's funny. Mike was sitting here, and a friend of mine. I'm not going to mention names or the stock, but he called me on Friday on expiration, and it was a biotech. But anyway, and there were options. The stock was at $8, and the $5 puts were trading at 35 cents with 20 minutes to go in the day. Okay. So, he called me up. He's like, "This is free money." Blah blah blah. I'm like, I don't know. Nothing is free. Somehow they
Nothing's
know.
for free.
So, needless to say, it ended up being free. I didn't do them, but the stock was down, or is down, 41% today. So, listen, the options know the skew is there for a reason. The hedge options are the greatest vehicle to use to hedge and hedge risk, enhance return, and utilizing them the way you do to basically find options that are cheap versus other options, and that leads us into what you're talking about. And if you'd like, you can explain a little bit about when you need them, you have to have them, and all of that stuff.
I mean, I think you brought up Fawcett telling you to stay on the bid. Well, obviously, you're probably selling more than you were buying, I would imagine. So what typically happens there, and obviously that's an extreme case, and I would imagine the AMR UAL crashed almost 2 years to the day. That Friday, the Friday the 13th of October '89.
That was the mini crash.
AMR UAL. No, the regular crash was '87. I'm talking about '89. Remember that?
That was the mini crash. Remember when I'm not going to use names, but someone at Spear Leads came in and stopped trading on the XMI when everything in the world was trading. Remember that?
I remember that. That was the mini crash. So that's October of '89. So the point Larry's making there is like, and Larry related the story about the calls he sold them at 14, they're 50 bid. Well, that's because when people are short volatility and you get an enormously dislocated move like you had. I mean, that was, I think, a 20% move, if I'm not mistaken. I went from on a Dow basis in one day. So now anybody short these things, if you're long puts, I mean, what were you better off doing then? Buying futures or selling the puts out? Well, I don't know. It looks like people were futures buyers because that's what a lot of professionals are trained to do. So now that creates, and now all of a sudden, as the market continues to snowball lower, those sellers aren't really around because they've already hedged up with futures. So now the guy who short them is getting a call from a clearing firm. Well, you got to get these off your sheets, or you got to put something on your sheets that are protective in nature. You've got to buy some downside, anything, just to get anything on your sheets. So you buy what you can buy, whatever the hell it might be. So if it's a put that would traditionally trade at $1 and now it's trading at $8, you got to buy it. It doesn't matter because there's a dearth of sellers. And very frequently, what you have there is, I remember, what you have there is you don't have an overwhelming number of, I think at the bottom in a move or the top in a move, they're usually not marked. I remember the guy Hull talking about this because he was a big futures buyer that day. And I remember like the bottoms really aren't bottoms in futures markets or whatever aren't really marked by over an avalanche of sellers. It's marked by an absence of buyers. So like all of a sudden when bids start to show up, well, there's at that point in time, by that point in time, I should say, the sellers have all dried up. They've already sold. So now you just got stragglers out there. So that's why you get these freaking spikes. So what I'm saying, you buy what you can buy in the downside. Say as we relate to Apple here 31 years later, Apple goes from close 190 on earnings night, opens 197. It's 200 vols coming in. Now I'm in bold. I love the stock. I think the stock could trade 220 by November expiration. So why don't I buy a little stock and I'll ratio right the October 220 calls or the Sep 28 220 calls to enhance my returns. Vol's on his way back to 14, 13. Who knows? Well, there's nothing. The stock's bulletproof. I'm not worried about the downside. Well, there you go. Right. All of a sudden, so I didn't. I'll speak for myself. I didn't think Apple could move 20% in 3 weeks.
No,
I didn't think the top stock, the most well-capitalized stock in the United States could move 20% in 3 weeks. That would be a low probability event in my estimation.
Right.
So now we have here is you guys long the stock, but all of a sudden, as we press 220, 215 to 220, you're short 8 week, 7-8 week options out, and now they're a 40 delta. Guess what? You're short now. So right. You got to get something. Now, do you want to reach and buy the stock? I don't know. Maybe. You want to reach and buy I think there was a guy.
It's hard to buy the stock now because
right. So or do you buy like the 230 calls, the 235? There was a big buyer in the 230 calls. I think that day, the Friday before Labor Day, whatever the hell that was, org 30 or something like that, or 29. Right. So all of a sudden, that guy, I don't know where he's experiencing pain from. Guys buying volatility right there. They're not doing it as an opening position.
No, but
this guy's buying out 230. He's buying like SEP 230 calls. 50,000 of them traded. So all of a sudden, that impacts everything. That's like throwing a tire into a swimming pool. That's going to dislocate. It's going to move the water around. Now people, you sell the 230 calls. And this stock's had a big move. I know if I sold you the 230 calls, I'm not looking to buy the stock up here. I'm worried about a disaster. I'm going to run and buy the 235s or the 240s or something. I'm just going to buy more upside, and that kind of bend. That's what I think. My dime store. Calculations. That's what I think force volatility higher because you buy what you can buy, whatever the heck it is, to cap it, to cap that loss. And I think and it happens to everybody. Everybody loses, and everybody has that spot where they say, "Uncle." Anybody who tells you they don't hasn't been in the game.
I get that spot all the time, and you gotta say it, but. No, what happens in a lot of these cases, and it would happen to me, is like you say, you reach for something. Like for me, in managing a position like that, the hardest thing to do, it's the easiest thing to get execution on, which is the stock, but it's the hardest thing to hold because it chews up so much of your margin on your position. Right. So you're reaching for me to sell, let's say, a 20-point put spread, which is just like selling pretty much a naked put against the naked, call that I'm now short because of the ratio. So, but all of a sudden, I'm selling that put option spread for 2 or 2.5 or 3, and the stock's up 7 in a day. You're, as you would say, hammered or blown out. So that doesn't help. So a lot of the skew comes from and the higher volatility comes from the fact that people got hammered on that
right,
trade.
And that's not
but it creates
that kind of move that put isn't going anywhere.
But it creates good opportunity.
Remember when Google came out? Google was what, 03? When did it first come out? I forget. Remember, was it 03? I think it was. Well, that doesn't really matter. 2003, 2005. Remember, it kept getting delayed. Initially, it was going to be 120. Then it's 100. Then I think it finally came. The IPO was $85. And if I'm not mistaken, the first day they brought it down to the floor. They think options listed on the same day as the stock opened or something. Maybe I could be wrong. Anyway, the first trade when it was publicly traded, after the IPO, was $100. And I think either they got options on the same day or soon thereafter. And I think it was August-ish, like that, middle August 2003. Okay, now flash forward to, I believe, it might have been November, maybe October, or I thought it was December for some reason in my head, but whatever. I think that first earnings cycle, or we'll say the January earnings, say it's 5 months later, for argument's sake. I think the first trade of stock was 100. I think within 5 months or 6 months, the stock had earnings, and it rallies like 30 points, and it's $210 or something like that. And I remember I wasn't trading. I was trading indexes at the time for Motorola. I think I was trading Motorola. No, I was trading indexes. Anyway, guy comes in and wants to buy. He goes out a year. I think he might have bought December of 04. He wants to buy a 10% out of the money put. We'll say the stock's trading 200. He buys a 180 put. He pays like whatever the hell it was, $2. We'll say $2 or $3, $2.50 or something like that. Probably more. say $5. They're coming out of it. They're bringing people in from other crowds to sell these things. Because I guess when Moses came down from Ararat, there was an 11th commandment, like Google volatility. Google long-term volatility should be, I guess, at the time 18 or 19. Anyway, we'll flash forward. The stock was 200 that day, and I think within a month it was trading 240. I mean, and it just absolutely ripped higher. So now, where do you think those puts are? Do you think those puts are going anywhere?
No, they're probably higher.
Right. You sell puts, you sell stock. Right. Those puts, I think they were unchanged. Because now
anybody with that time duration.
Right. Because as well as like that, Larry, if you bought, what's the stock in the news I see in the chat? Telray, the pot stock.
No.
Right. I mean, I think that, it's obviously off topic, so to speak. It's not as universal. But hey, the stock traded at 300, right? Did it trade 300 one day last week on an enormous squeeze?
I think it traded 300, and yesterday it traded 198. I mean, I'm sorry, 98.
98, right?
98.
Yeah. I mean, so
Come
I mean,
on. It's down 200.
If you're lucky enough, didn't it go from 150 to 300 in the same day?
Yeah.
Something like that.
Some crazy stuff.
Yeah. So I mean, as well as I do. I mean, if you think rationally about it, hey, you bought the stock at 150 that day, and now it's 285. Well, I think the stock might go back to 150, but I don't mind locking something up. Do you really care? This is what I always, I'm as mathematically focused on this as the next guy. But like in the Google example, so the guy paid $6 for these puts. They couldn't wait to sell them, and the stock's $200, and then it's a bloodbath in there a month later. Did it really matter? Do you think that guy would have cared whether he paid $6 or $7?
No,
probably not, because he was looking to rip him up anyway.
Right.
He was.
And now
he was right. It was pathetic.
Right, and now he takes $80 out of the stock. He owns the free put. He can sell it if he wants or hold on to it. And the case being, if he held on to it after he kicked the stock, he made on both.
Right, right, and that's the thing. I think the last thing, and maybe point this to people because we're in a period now of somnambulism. I mean, I think we're almost conditioned, and it's Pavlovian in terms of every shallow corrective move being an incredible buying opportunity. But I think what's always served me well, and I think you well as well. There's a lot of wells there at one time. The ability to have the foresight or the discipline, I guess is probably maybe a better word, to have some type of protective strategy so that you can be a buyer when you get that dislocative move, when you have a day like Feb 5.
Right.
Where you can step in and buy, because as well as I do, that's where the biggest money is made, being able to buy stocks on those days, or being able to sell options on those days. How do you feel about that?
No, for sure. You want to be opportunistic. You want to be able to do that. I'll tell you something quickly that was interesting on Feb 5. We actually were short no puts, and we wanted to sell, and our clearing firm actually wouldn't accept sell orders. So they were blown up, out of business, or in trouble, and we were basically held up. So basically everything was liquidation only. So it's funny in a way, people don't know this, but a lot of the local futures firms were tapped out from that one day. Oh yeah. I mean, they needed liquidity, and they, obviously the market bounced back in a day and a half, so they were fine. But there were some serious issues that day, very serious. So again, I'm not calling for that, but at some point, it just can't be this easy. It just can't.
Absolutely not. Like, hey, even the Patriots lost 2 in a row.
That's true, and and Mike and I are praying they got 3 because our Dolphins are coming to town this weekend in Foxborough. So
I'll give you one thing, and these are facts. I don't make this stuff up. You go back to the entire Brady campaign, Brady's entire career. I think he's trailed by 11 or more. I think 87 times over 300 games. I'll say. He trailed by he trailed by 12 or more. That's 2 touchdowns, right? Because you can't get the 8 and the 3, so it's roughly 2. He's trailed by 12 or more, I think, 76 times between 2001 and week 11 of last year. So that would roughly be 16 and a half years. So that's 256, 264 plus about 25 playoff games, 290 games. So he's trailed by that 76. He's had about 76 games where he's trailed by that. So roughly, what's it, about 2.5% ballpark to 2.7%, 27%. Now, since week 11 of last year, they've trailed by 11 or more 8 times. So that's a total of, I think, 8 games plus. I'm sorry, he's trailed by 11 or more since the Super Bowl of 2016. He's trailed by 12 or more 8 times in the last 22 games.
That's unbelievable. He doesn't
roughly
have
36%.
Listen,
but now, like you saw against Detroit, they don't. I mean, not coming back against Jacksonville. Jacksonville's an excellent team, but now they don't come back against mediocrity.
Oh, as Larry said, though, if they lose, I just chimed in. Football Talk came on. If they lose, they are 1-3. The Dolphins would be 4-0.
Hey, you know what? It's just too bad the game isn't in Miami because Brady doesn't like the warm weather.
But it is amazing. You know what? Also, Belichick. There are a lot of cracks coming out. They're trying to put rifts between Belichick and Brady and how they don't like each other.
Really?
Well, look, it's got to end, right? I mean, how did it end for Peyton Manning? Maybe you saw it at the end of the middle of the 14th season. He just started floating balls, couldn't get him to the boundary.
Well, he got to the Super Bowl at least, but the team was unbelievable. He couldn't throw the ball 20 yards.
Right. And you watch. I watch. Brady can't get the ball outside the numbers. He can't drive it. He's 41. Well, he's 41 years old. What do you expect? 41 years old. 41 years old. I could barely tee up a golf ball.
Conversation though has happened so many times over the past 5 years, and then he's going to win 9 in a row.
I don't know.
I don't know. I think it's over.
I hope not as well. But this conversation's happened at least the last 4 years, and then he wins 10 in a row.
Wow.
Yeah, but there's nothing. I just think the defense isn't that good, and his arm looks shot. I mean. They went first 3 downs, and they fall behind. Look, if I took the last 20 games of any team, and I showed you that they fell behind by 12 or more 8 times, you say, who is this? This looks like some middle of the road team, some 500 club.
He's got. Listen, who's coming back? The guy that's out.
Edelman.
Edelman's coming back off his steroid suspension.
Yeah, you know as well as I do. Edelman, Welker, Amendola. You put them anywhere else, they're just guys.
Right. No doubt. No doubt.
You play with Tom Brady, you're a star.
But they also have that guy from Cleveland that's Josh Gordon, but he can't stay on the field. So anyway, we'll keep our we'll come back on and give our football analysis on pregame Friday. But
okay, great speaking with you guys as always.
Tom, thanks so much. I really appreciate it.
Thank you.